In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, welcome Market Rebels. It's that time again for Coach's Corner. But once again, we're actually recording this in the morning. We have a special sales webinar today. So, Stu, what are the futures looking like this morning here?
It seems the last few times we've been doing this in the morning, we're kind of flat. The NASDAQ futures are up nothing, 40.
Yeah.
The minis are up 4. That looks like it might open down around 40 points or so. Yeah.
Okay. Basically flat. Not a whole lot going on, but well, of course, it's another day. We never know what's going to happen until we get to the closing bell.
Absolutely.
But at any rate, we've got a very cool Coach's Corner for you today. One of the things that we like to do is a theme with Coach's Corners to bring to you ideas and topics, useful ones, but things that you're probably not going to hear anywhere else. If you watch all of the kind of the YouTubers and the people that just keep recycling everything that everybody else has said, they all teach the same stuff. And we want to get away from that. We really want to show you the tips and tricks that help you to make better decisions and to understand strategies better. And so that is very fitting for today's topic. So here we go, Stu.
I know let me before we get into it, let me just say I kind of got a heads up on what this topic is. I don't always, but sometimes I do. And I've had several clients, one of which is coming to mind, that was using this particular strategy, and they were getting killed. They couldn't figure out like what was going on. Generally, it's going to have something to do with like how much movement the stock is taking, and there was plenty of range.
Yep.
Couldn't figure it out, and we're gonna hit that today. This is a really cool topic. So
excellent, very good. So as always, we like to start off with our little thought-provoking question that we call Chalk Talk, our little coach's huddle here. And here we go. The stock is 100, interest rates 5%, volatility 20%, and you want to use the 1-year $100 straddle. Now, the stock price, interest, and volatility don't really matter as much as we're just showing that we have to have some inputs into a model. But the thing is, if you understand a straddle, by definition, it's a same expiration, same call and put strike. So most people would say, well, should be obvious. Well, let's give you some choices here. All right, so remember the stock is at 100. What would you use if somebody told you to place a straddle? Would you use the 100 call and put, the 105, or the 107?
Here's a hint. It's not always as obvious as it looks.
Exactly. I know some people are saying, what a stupid question. Well, of course it's going to be the 100. Not so fast.
Negative.
Might be, but it might not be. So you got to hang out and find out what's going on here. So here we go. The art of understanding at the money. And again, one of the things that we like to show is that
you just don't get to be much more of a basic term than at the money. This is taught in day one of any beginning options course, and yet there's mistakes that are made. People get off to bad foundations because of the basic definition of at the money. It is a definition, but it's not the only one.
Right, exactly.
Yeah, so again, talk about confusing. So here we go. There are actually three types. Count them, Stu. One, two, three different types of at the money positions or strikes. And if you ask most people, even people who claim to be experts and been trading for years, will tell you that there's one. So here's the first one, is where the strike equals the stock. So we have the $100 stock, and we would look at the $100 strike. That's really the textbook definition, where the stock and the strike are equal.
Yeah. I would say 99% of the people would take that
would take that one as saying,
and that's the end of the story, right?
End of the story. No other definitions, right? Then there's what's called an at the money forward. Now, in the financial world, whenever we talk about forwards, I'm sure most of you have heard about futures. We were just talking about the futures markets. Forwards are the same idea. They're just privately negotiated. But the word forward always has this connotation of going out in time. We're kind of pushing this idea forward. And when we look at an at the money forward, the call price equals the put price. Now you're going to find out if we do this definition where the stock and strike are equal, those call and put prices are not going to be equal.
No, not a chance.
So if we do the at the money forward, we're going to get the call and put prices to be equal. And then if that's not confusing enough, we have a third type. And now keep in mind, these aren't just three different definitions. They are three different types. They lead you to three different potential answers. So the at the money delta neutral straddle, sometimes we just call it a DNS. And that is where the call delta equals the put delta. So notice the difference.
Yep. I think, Bill, this is kind of what people want to do.
Right.
When they're right. Am I
correct? Right? Yeah, when they're trying to do a straddle. Yep.
When they're trying to, hey, I want to do the straddle. I don't really want to pick direction. I just want to trade the range.
Keep your deltas equal.
This is the one that most people are really thinking about doing, yet they go into generally number one, and a lot of depends in there. They may be really misguided.
Absolutely true. So as Stu said, one of the reasons for using a straddle, it's really a gamma strategy, but people are saying, look, I have no clue as to which direction. Like a classic example is maybe an FDA announcement. It's either going to be up big or down big. I don't know which direction. It's just going to be big. So let me play both sides. Well, if you're admitting that you don't know which direction, you would like to start with delta zero or delta neutral. Mm-hmm. And so a lot of people say, well, I know that with the when the stock and the strike are equal, my deltas are about 50. And so therefore, if the stock is 100 and I pick the 100 call and put, that I should have delta neutral. And that is not true. That's what we're trying to show you here. So let's take a look at these. Let's look at the at the money definition where the strike equals the stock. So if we have the stock at 100 and we use the $100 call or the $100 put, okay, we're going to put these into, or just as options out there. What this means when we have the strike equal the stock is that the option holder, the person who's the buyer, is indifferent to exercising. If I have the $100 call and the stock is 100, I could exercise and pay the 100 strike, or I could just let the call expire worthless and go buy the stock at 100. Same difference. And that's what it means to be indifferent. You pick, it doesn't make a bit of difference to me. Same with the put. I could either exercise and sell my shares for 100, or I could do what? Forget about the put and just sell the shares. So that's when we talk about, I guess what I would call the textbook definition, or the more common one, is that this is it, where the stock and the strike are equal. And so this is what you want to think of what that means, is that the option holder is indifferent to exercise. All right, so keep that in mind. Before we go to definition number 2, please remember marketrebellion.com/get started. Tremendous amounts of good stuff there, articles, videos, all free. Topics just like this to help you get started and make better decisions with options. So let's take a look at an example here where we have the stock equals the strike. So we're going to put this into a pricing model. I've got the stock at 100, the strike at 100, 360 days, roughly a year, volatility at 20%, interest rates at 5%. And what do you notice over here? The prices are different, but even more important, our deltas are different. Look at that, 63 versus 36.
Let's go back to I want to trade range. I don't really want to trade direction. And look at the difference in these deltas.
Huge.
Stock goes the wrong way. Stock goes down on you. You're going to get buried.
You've got positive deltas, right? Now, many of you know
there's almost 30 deltas here.
Exactly. Many of you know that if we ignore that minus sign there, that these should add up to 1. So we can see 63 plus 36 adds up to 1. But the difference in them, it's not 50-50. And if you talk to most people, when they say, oh, an at-the-money option has a delta of 50. Well, a lot of times it will, especially for short-term or cheaper stocks or no interest rates. You start going out in time, pumping up volatility, interest rates, all bets are off. And we're seeing it very clearly right here. So
Really
notice
clear.
that with the, let's call it again, our common definition, where the stock equals the strike, the prices are different. Again, 1033 versus 557. And the deltas are different, 63 versus 36.
And let's put that into like real life. So say you did 10 straddles. That's almost 300 deltas.
300 deltas. And
Right,
the stock is
goes the
going
wrong
down.
way.
You're going, yay, I'm starting to make money on my puts. No, you're not. You're losing big time.
You're losing. You're long 300 deltas on the way down. Now it's getting smaller, the deltas, because you got the scammer.
Right.
But in the meantime, you're getting your what handed to you.
That's exactly right. Okay, so there's the kind of the basic definition. Now also notice something interesting, that the difference between the call and the put is 476. Okay, so again, we've got this 63 delta on our call, which why is it not 50? But why is the difference 476?
That number kind of rings a bell.
It does ring a bell, doesn't it? We've talked about that recently in Q&A. It's coming from the interest or the cost of carry.
Cost of carry rate.
So one thing we can do is to, if you think about, if you deposited $100 into a bank for 1 year at 5%, you would have $5 in a year. Well, if you're not receiving it for a year, it's not worth $5 today. So we have to do what's called the present value. So now here's a way we can trick the system into showing us that the model sees it that way. We'll keep everything else the same, but let's put the volatility. It won't let you go to 0, but let's go to like 1%, which is basically saying that the stock is stuck in the cement. It just, mathematically, it can't move. Well, if that's true, wouldn't the call and the put be worthless? Well, they're not. Look at that. The call is 476 and the put is 0. We still have a difference of 476. And so again, here's where it's coming from.
That's your interest.
Yep, you put the $100 into a bank at 5%, there's your $5, but you don't get it for a year. So we have to reverse that. We have to say, well, that $5 in 1 year, how much would I have? You can think of it as how much would I need to deposit today to have it grow to $5? So we have to back that out. 5 divided by 1 plus the interest rate would be 476. If you deposited 476 in a bank earning 5%, you would have $5 in 1 year. So that's the future value, 5. The present value is 476. And that's what the model is also accounting for in that call. So now take a look at this. Why is the delta 1 when it's at the money and it can't go anywhere? Shouldn't it be delta 0? See, the model sees this as being very much in the money, deep in the money. And again, that's throwing traders. So if you're deep in the money, your delta is going to be 1. So again, if you're looking at some of the stuff going on, this is just so confusing. That's what we're going to show you is why these numbers seem to be off. All right, now let's look at the money forward. This was our second definition. And here we have the strike equals the future value of the stock. We just talked about future value. So let's say we have the stock at 100 interest rates are 5%, and a 1-year at the money forward would be 105. So again, very simply, you deposit $100 into a bank at 5%. In 1 year, it's worth 105. And that would be the forward price. Now, if this were a 6-month option, you would just cut your interest rates in half to 2.5%. The forward rate would be 102.50. If it was 2 years, you'd have to compound them out. But that's the way that the model sees it. And when this happens, when we're looking at the money forward, the call price equals the put price. So we just saw if that wasn't true for the kind of the standard definition that most people talk about. But now we can get our call and put prices to equal. So notice over here we have the stock is not equal to the strike. Stock is 100, but the strike is 105. We've kept everything else the same. But what is this, everyone? That's the forward price. Again, taking our $100 at 5% would be worth 105. Let's push the strike to the forward price. And what happens now? Look at that. Now, the prices are equal, but we still have different deltas.
But they're getting closer.
We're getting closer. Good observation. We are getting
You're
closer.
on your way to having a delta neutral strategy.
Yep.
But it's really interesting. I mean, think about it. You know, the stock's 100, and we're talking about the 105 strike here.
105 strike should be way out of the money. These deltas
Right.
should be 30. That's what people think. And I'm going, why is it showing me a 54 delta? Yeah, it's because the model sees this as at the money. And that's important to understand not only when you're setting up your strategies, but how it's going to evolve over time.
And don't start thinking like this model, you know, is wrong in some way. It's just calculating value of money.
Yeah.
That's what we're doing here. We're trading money.
Yeah. Yep. So anyway, this really comes from what's called a risk neutral valuation in option pricing in theory. And so they're assuming that the stock is drifting by the risk-free rate. And why they do that is a whole separate topic. We're not going to go down that road, but that's why the model sees it this way. Okay, so now let's take our third one. Ready for this one? This is going to be a little bit tough. This is our at the money DNS. What does that stand for? At the money delta neutral straddle. Why is it called delta neutral straddle? Because it's going to truly make the straddle delta neutral.
This is what you're probably looking for.
What you're exactly.
You know, when you're thinking about the strategy of why you're doing a straddle,
right?
The methodology, not the methodology, like, you know, the behind why am I doing the straddle? You're looking at it because you don't really want any deltas. You just want to participate in a range.
You're admitting I don't know the direction. So if that's true, why would you want to start at 50 deltas or 300 deltas? You wouldn't. You'd want lots of gamma to swing you to positive or negative once that stock starts moving. But you'd really like to start your finish line or your starting line right at 0.
I would, at least.
For sure.
If I'm saying, you know, I don't have an inkling of an opinion about which way the stock might be going, why would I want to take a directional bias?
Exactly right. And yet people do inadvertently. A lot of times they won't even check their platforms. They'll go, well, I remember learning that the at the money has a delta of 50. So if the stock is 100 and I buy the 100 straddle, my call has a 50 delta, my put has a negative 50. So combined, I have 0 deltas. And they find out that's not true.
A client on YouTube said the at the money straddle is
right. It's
100.
It's going to be delta neutral.
You know,
so
meantime, you get into a stock that has you know, like a 70 vol or a 50 vol, and you're talking about
$2,000 stock and going out exactly.
It's going to be way off, man.
Way off. So when we do our ATM DNS, as we sometimes call it, the call delta equals the put delta. Now remember, before we saw the prices were equal, the deltas were off, they were getting closer, but now we're going to get the deltas to be equal. And to do this, we have to add the interest, but we also have to add a little bit of math here. Warning, we have to add a correction factor for volatility. And here's the way that it works. Don't worry about it. We're going to show you an easy method. You don't even need to do it. We just want to show you where it's coming from. So our interest rates in our example, interest rate was 5% and volatility was 20%. What you need to do is this. Take your volatility squared. That's just multiplying it by itself. So 0.2 times 0.2 is 0.04. We divide it by 2. We get 0.02. Just punch it into a calculator. If volatility was 30, you would take 0.3 squared. If you don't have a squared button on your calculator, take 0.3 times 0.3 and then divide by 2. And what you're going to do is to add that to the interest. And we get 0.05 plus 0.02 is 0.07. So now we have our forward price would be what? 7%. We need to forward our stock price. Previously, we did it by 5%. Now we need to do it by 7% to account for the volatility. So the at the money DNS is going to be a 107 strike. Now, again, in the real world, we'd probably have to go to 3 or 4 decimals. They might not even have the strikes, but you should get close.
So here's the thing, everyone. If you're looking to have a delta neutral strategy via the straddle, then just look at your deltas on your platform.
Oh yeah, we're gonna do an example a little bit. That's a great point.
Bill's showing us the math behind
just the math behind it,
which is really interesting. At least to me, it's really interesting. But you don't have to be interested in it. Just look at your platform. Pay attention to the Greeks.
I wouldn't do it because we're going to show you it's not going to come out that way on the platform, and we'll show you why. I wouldn't do that calculation. I'll do it maybe if we're teaching a class. But I'm just going to go to the platform and say, well, where's my 50 delta call? Where's my 50 delta put? And there you go.
Yeah.
Okay, so again, don't worry about the math. We do it just to show you. So let's take a look at this. Notice that our stock is not equal to the strike again. We've pushed the forward value of the strike out by 7%. That's 5% interest plus what? 20% squared divided by 2. And look at what happens now. Look at
now you have a delta neutral strategy.
Yeah. See, now the prices are different. Before they were equal. In fact, the put's a little bit higher, but the deltas are equal. Okay, now again, you might say, wait a minute, those are off. Well, remember, we'd actually have to go out probably several decimals, and it's certainly going to get us very, very
That's delta neutral.
It's delta neutral right there. 0.498, we can call that 0.5. So we've now pushed our deltas to be neutral, but notice to do it, we would be doing the 107 strike. Who would have guessed? Most people say, what are you doing? You're taking a heavy bearish lean because that put is deep in the money. No, it's not. Not remotely close. The pricing model sees it as at the money. And you might say, well, who cares how the pricing model sees it? That's how the options see it.
That's how we see it.
That's how they're going to work, whether you see it that way or not.
Now, as a footnote here, Bill's got in 360 days. He's got a year out. Keep in mind that just think about compounding interest.
Yep.
As the time is ticking by, this interest piece of the puzzle is becoming less and less of a factor.
Correct.
Till eventually it becomes not a factor. So the 107 kind of becomes the 106, becomes the 10. You have to make that adjustment along the way. Not every day, of course, but along the way. That delta neutral straddle is not really a delta neutral straddle anymore as time is moving forward as well. So you have to keep an eye on it. That's the point.
Exactly. So if we take, if you wanted to do a, let's say 6 months. All right. So how would we change the calculations here? Well, the interest rate's easy. That just scales linearly, right? So we would make that 2.5. But what about this? Remember, that's with the square root of time. So if we do a half a year, 0.5, take the square root of that is what? 0.707. We take 70% of this number, and then we add it to 0.025. Forward that, come up with a strike, and you'll still find that your deltas are neutral. Now, again, don't worry about that because
just look at your platform. Just monitor your, all my years on the floor. I mean, you had to know what your deltas are, right? All my years trading off.
That kind of helps if you're going to be a market maker.
Well, yeah, but it doesn't, whether you are or you're not. Look, you got to know what your deltas are. You have to know what your deltas are going to look like as things unravel in the real world.
Yep.
being behind the eight ball, waiting for your P&L to show you that, oh my God, I lost a bunch of money. Now I have to figure out why. Like, kind of do it ahead of time and look at potential outcomes. And whoa, I'm wrong. I don't really want to be long, or I'm short and I don't really want to be short. I want to be neutral, or even I'm long and I want to be short. I
Right.
mean, that happens all the
You're
time too.
gone the wrong
You know,
direction.
I'll have clients say, they give me their position, and I say to them, "Are you bullish or bearish?" And they say, "Well, I'm bullish." And I look at their position, and they have a short
Opposite,
delta position.
opposite direction. Yeah.
Dude, like, what are you doing? You're
Happens
short
all
deltas.
the
You think
time.
it's going up? I mean, no wonder you're losing money.
And that's why we want to show people this. So again, for more topics just like this, marketrebellion.com/get started. Please visit us there. Lots of great material. So let's do a quick example here. Let's say that our stock equals a strike. This is kind of our basic definition. And we come out here and we say, okay, Stu, I know that the at the money has a delta of 50. Of course, I never bother checking it. I just know that because I've heard it. And I want to do this straddle.
Yeah.
And now, again, side note, most people aren't going to be doing a 1-year straddle. We're doing it just to exaggerate
Yeah.
the effects here. But that aside, we come up, we find out the call is 1033 and the put is 557. Our deltas are what? 63 minus 36. We
Yeah,
have
27
27 deltas. As Stu said, you put that on 10 times, that's 270, almost 300 deltas.
300 deltas. That could be a piece of change when it
That's a
stops.
huge piece of
$10 a
change.
clip.
So
Right.
here's what you think that you're doing, right? So here's our V is right at the strike. So people are thinking, well, the stock is right here. So as soon as it ticks one tick up or one tick down, I'm starting to walk into fewer losses and we'll eventually head into profits. So our stock is right here. But what does our current risk graph look like? This is why the expiration graph can be very deceptive. We should only look at that at expiration. If you want to look at it today, it's telling you where you're heading or the nature of the strategy, but it is not in any way telling you your P&L today. If we look at the current curve, what do you suppose that looks like? Most people would think it's going to be a U shape right there at 100. That's what they're envisioning, and it looks like this. Check that out. There's your 27 deltas. You can see we've got a little bit of a angle right here. And where do we have to go to get flat? Down over here. Probably like 92 or 3 or somewhere.
So, what happened here, people? The stock went down and you were long deltas. Bang, lose money.
Lost money. Yeah, so if the stock were 93, or whatever this number is right in here, and you did the 100 straddle, then you're delta neutral. Then you're right there at that low point starting to make money. But because you started here at 27 deltas, and in your mind you're thinking you're delta neutral, you're going, how come this thing's not working? It's because the market's rigged. It's the market makers. You can see where people start thinking that everything is rigged, and it's 99% of the time, it's from not understanding how the strategies work.
Bill, I probably never told you this story. I'll make it a 10-second story. I got caught in this very early in my career. I was involved in something like this. It was a takeover stock. I believe it was MCA. And, vols were juiced, and, a lot of people were trading the outer months. And here I'm thinking I'm neutral, and I wasn't. And the stock got hit, and I'm getting buried on my P&L. And I'm thinking I'm supposed to be making all this money. And
Yep.
this is the kind of thing that was going on. I didn't get it at the time. I figured it out, and then I knew, but I had to learn it. And
That's right.
it was a hole in the risk management procedure of, I didn't know what I didn't know. And if you're going to be an efficient person looking at various pieces of risk, then you have to have an idea where to look.
That's
Right?
well put. It's one of the things that we always
them.
talk about here at Market Rebellion, why the education is so important. Why reinvent the wheel? We've made all the mistakes.
Yeah.
And, just we can prevent that from happening and making people sit out there for years and years, scratching their heads, trying to figure it out. It's probably not that hard once you know the secret. And so we're hoping to show you that this is one of many things where strategies can appear to go wrong, but if you understand how they work, you'll see,
and it's not a secret formula, everyone. Everyone wants to know the magic button. It's
Yep.
it's educating yourself
Yep.
about what this product
Understanding about
is.
what they do, not what you want them to do,
No, no,
but
no.
what do they do?
What do they do? What can I expect out of this option?
Right. So now that you're armed with some new information from Coach's Corner, stock is 100, interest rates 5%, volatility is 20%. You want to use the 1 year $100 straddle. Which strikes would you use for your call and your put? Well, if you remembered from the presentation, 107.
It's
Now,
not going to be
again,
the
to show you
100. You know that.
that you probably learned something is that my guess is most people chose 100
Yeah,
at the
they did.
beginning. Yeah.
105 got closer, but to be
105 might have been closer,
spot
but
on is really the 107.
yeah, it's the 107. So where'd my platform go here? Um, there we go. Let's do a quick look here. You want to do Tesla?
Yeah, Tesla's a
Okay.
nice
Now,
hopping
again, the
stock.
markets are not open, but we should get some quotes in here. It'll at least give us the idea. So the
Yeah,
first thing is
it'll be a tiny bit off a little bit because the
might be.
platform's actually reading 324 and we closed at 321, but it's fine. It's
Yeah.
very close.
So we can see that we got some pretty heavy vol here. I mean, look at this. We're talking 60, 50, 60, 70, depending on which month. Stu, let's go out a year, just kind of make the numbers easy, just to.
Okay, I was looking at all right, you want to go out to July? I was looking at 6 months. We can go out to July. That's
Yeah,
fine.
we can do a 6 month later. Let's just do this one for starters to show
Okay. Yeah.
how wild things can get.
Yeah.
So here's our delta. Now the stock, at least at this time, was 321. So
Yeah.
let's find the 320 is the closest we're going to get.
320. Yeah, that's
most
fine.
traders would say, let me do this and I'll be delta neutral.
Yeah.
Well, look, you've got 63
oops.
deltas here. You got 39 over here.
It's not going to work.
You're off by a lot. So if we want the deltas to be equal, of course, that begs the question, relative to what? If you want it to be relative to the 320, and that's 63, then what do we have to do to find a 63 delta put? Oh, they're way up here.
See, so just start scrolling through till you find that delta neutral. My platform's actually showing at 390.
At 390, yeah. Now that's also a good point that a lot of platforms use different
interest rates,
different pricing models, different exactly.
Yeah.
So,
but you could see, like, what do you got here? You got 51. You're showing a 380-ish, 370, 380.
Yeah.
Look at the difference versus 320. I mean,
yeah.
Whew, that's a big difference.
Yeah, and if you want them to be 50 deltas, all right, so we could find, here's my 50 delta on the call.
Yeah.
And we can see that roughly we're off a little bit.
Yeah, a couple deltas.
But not too, but notice that we're at the 380.
Right, that's what I was
with
just
the
saying.
strike with a stock at 320.
So you were a little bit off.
You're way off it. So if you really want to be delta neutral, you need to be trading the 380 straddle, and most people would be looking for the 320. And you're just way off.
And it's really very basic. If you got to go back to if you go back to the idea of, well, why am I doing a straddle? You're not doing it because you think the stock is going to be sitting still. You're doing it because you think it's going to be rocking and rolling one way or the other.
Yep.
Right. So you can't have that directional bias if you really don't have a directional opinion.
Yep. So there we can see where those deltas are equal. So again, there's no need to have the formula. I wouldn't use it. I would just do this and say, well, where do I have roughly 50? It's in here. What's important about the formula is to understand why you're going to have this discrepancy and go, but wait a minute, I was told that 320 is the at the money. Why is this showing me 380? Now I'm confused. You have to realize that's the forward rate. And that's why it's showing it. So the more expensive the stock, the further out in time, the higher the interest rate.
More money's involved.
More money's involved. It's going to push that even further. Do you want to go to a 6-month one, Stu?
Yeah, we can do that. That would be the
Jan 16.
The 183. Okay, we can do that one.
So if we want to find
So hold on,
There-
everyone. It's like, which way do you think we're going? Up higher in strike or down
Yeah.
lower in strike? Think
Yep.
about that. Think about what we've been talking about.
What's
Where
happening with the
we
time?
go. So we're looking at a delta neutral strategy. I'm looking at around
Here's 51 deltas on my
360.
350. Here's minus 52. I could do a 53.48. You can see you're not going to get them perfect because we have $10 between here. We might need to go dollar increments or even out to several decimals, which in the real world you can't, but you can certainly get closer than if you
You
had
get
gone to the
pretty close.
320.
And if you really, are so bent on having it perfect when you start the neutral side, I mean the delta side of it, sometimes you might have to split the strikes and have a strangle instead of a straddle.
Another good point.
A little bit, I mean, it's not a big
Yep.
deal, but
Yep.
if you're
So
looking
take a look at the 320. If we did that here, now you've got 59. I think we had 63 before and
Yeah.
42.
Yeah, seven.
So we're still off.
Yep, 17 delta.
17 deltas there. Not as bad as almost we had what 27 I think last time.
Yeah,
But now we're down to 17.
but it's still not delta neutral.
It's still not delta neutral. Okay, so everybody see that. So anyway, I hope that helps everybody to have a better understanding of something that seems to be such a simple definition. What's an at the money option? And once you become a professional level trader, or at least more astute, you'll realize no question that you ask is probably all that easy. And that's why all of our Q&A people know that Stu and I, it's kind of become the joke, hasn't it? No matter what they ask us, it depends. And now they're finding out why. Because if you ask most people, the at the money would be the 320.
Yeah, like this one. What's
Yeah,
straddle?
320. Of course, it's 320. I know that. And then you ask Stu and me, we'll go, I don't. It depends. What kind of neutral are we talking about?
Exactly.
So anyway, we hope that gives you some good things to think about. Let's see what happens to our markets today. We're looking for another good potential day. We got Q&A today at 12, and we'll see a lot of you there. And for the rest of you, we will see you next Thursday on Coach's Corner. We'll see you then.